Hello everyone, let us continue with our discussion. In the previous lecture, we have completed two LOS and if you look at the book, topic is quite short, but I have tried to uh, explain the things in more detailed way. Okay, so it's taking time, but if you'll do it, then you will understand that yes, you are doing it properly, and along with that you are also making the notes, so it will be easier for you to revise the concepts as well as side by side. Okay, now we will cover up the next topic in this lecture. Give the heading: confidence intervals for war. Confidence interval for war. See, it's always a point of discussion when you are calculating the war. You should take 99% or 98%, 97.5% or 95%. What you should take? Okay, so this is always debatable stuff. Okay, so over here the analyst will use as per their own judgment. Clear? Now this confidence interval is very important. Clear? So we will explore in this lecture like what confidence interval are, why they actually matters, the challenges when you are calculating them, and the different methods associated on how you can estimate the confidence interval. Okay, so first of all we'll begin with what is this confidence interval is. Clear? So when we are calculating the war, what we are doing, we are doing an estimation about the risk. Clear? But we all know that no estimation is 100% accurate. You cannot say that your estimation is 100% perfect. Clear? That's why it's an estimate. Clear? Now we need to make it reliable. Clear? So basically we need to understand that how reliable our estimate is. So the point is how much you can trust on your estimate. See, it's an estimate, it's not an accurate answer, so it's an estimate, but how much you can trust on this. Clear? So that's why we place a confidence interval. Okay, means if I'll say that today Sachin will score 95 runs. Now you'll ask me how much confident I am. I'll say I am 94% confident that Sachin will score 95 runs. Clear? So this is my estimate and this is the probability. This is the probability. Clear? So we place a confidence interval around it. Clear? Now suppose a bank calculates its one day 99% war, and that is as 10 million rupees. Okay, now what is the meaning, or you can say the interpretation of this? Write down. This means that this means there is a 1% chance, there is a 1% chance the bank could lose more than the bank could lose more than the bank could lose more than rupees 10 million in a day. So this shows your confidence, and this shows the amount, and this shows the time period. Clear? But we are not completely sure about this estimate. Clear? So we can calculate a confidence interval. We can calculate a confidence interval and we can rephrase our statement. We can rephrase our statement like this. We are 95% confident. We are 95% confident that that the true war is between 9 million rupees and 11 million. So I have taken a confidence interval that my value will be 9 to 11. Now why I say so? See, when I say Sachin will score 95, now if he will score 94 or 96, my estimate will become wrong. Clear? But if I'll say that he will score somewhere around between 93 to 98, he will score somewhere between 93 to 98. My estimate seems to be genuine, my estimate seems to be correct, and there is a possibility that he can fall in between this range given a particular confidence interval. Clear? So basically this interval actually help us to understand how precise or uncertain our VAR estimate is, because we are using this confidence and amount in the same sentence. Clear? Now the point is, why don't bank commonly use confidence interval for war? Clear? Very important question. See, even though this confidence interval are useful, but banks purely rely to calculate them for war. Why? We need to understand, see, why bank will not use this confidence interval. Why they are calculating the war? Because calculating the confidence interval accurately is difficult due to the many challenges. Clear? Means the point is, why they are calculating war, why they are not calculating the confidence interval, that your losses are within the range. Why we say that with 1% chance my loss is $99 million, or I can say with 1% chance my loss is $100 million. Why I use this? Rather I use this that I am 95% confident that losses are between 95 to 120. The reason is that it is very difficult to estimate accurately the confidence intervals. Clear? Now what are the reasons I cannot estimate the confidence interval correctly? Number one is data quality and availability. Data quality and availability. Data quality and availability. Then second is model assumptions. Model assumptions. And then third one we have is historical findings. Clear? Now if I'll go deep inside these points, then we will start with the data quality and availability. We have discussed it many times that sometimes your data is missing, sometimes your data is incomplete. Clear? So if we don't have enough past data, our estimates will become unreliable. Clear? Now when I say data quality, number one, it can be outdated, means market condition changes a lot. Clear? But old data will not reflect the current scenario, so this is also impacting your data quality, and hence it will impact the outcome. Clear? Returns of the data is non-normal, means we all know that many statistical methods assume that returns follow normal distribution, that is your bell curve. Okay, this bell curve, but sometimes the data which you get, they are not normal, they are not normally distributed. Clear? However, now coming to the true fact, however, financial returns, they often show fat tails and skewness. Okay, means in reality, see, there are two aspects: theoretical aspect and practical aspect. Clear? In reality you will see fat tails and skewness. See, this is the scenario when you are doing it on theory, pen and paper, so you want normal distribution, but in reality you will see that distributions have fat tails, and skewness means there are extreme losses. Clear? They predict that extreme losses often very less, but in reality you see that extreme losses and extreme gains are higher than predicted by the normal model. So this also lead to the inaccurate confidence interval. Clear? Are you getting the point? Write down. Think of stock market crashes. Full stop. If a model assumes normal return, it might underestimate the probability of extreme losses. Comma, making the confidence interval too narrow and misleading, making the confidence interval too narrow and misleading. Underline, underestimate the probability, underline this part, underestimate the probability, and underline too narrow and misleading, too narrow and misleading. Clear? Coming to the second point, model assumption. See, when you are calculating the confidence interval, clear, we have to choose the probability distribution for the VAR estimate. Now, what if we will choose the wrong distribution? Our confidence interval can also be wrong. Clear? Standard methods assumes normal distribution, but just now I have discussed that market return do not follow the perfect bell curve. So if you are using normal distribution, your model is incorrect. Clear? Now, what is the alternative method? What is the alternative method? So write down. Number one is pseudo historical returns. Number one is pseudo historical returns. So instead of using the actual past data, we can adjust the historical data to reflect the current portfolio. Clear? Second, non-parametric method. Non-parametric method means you can use the order statistics. You can use, see, first of all, write down non-parametric method. Non-parametric method. Now, when I say non-parametric method means you are not presuming about the distributions. Clear? So, what you are doing? Number one, you are using order statistics, and bootstrap method, Now, when I say order statistics, write down what is this? It uses ranked historical returns, ranked historical returns to estimate VAR and its confidence interval and its confidence interval. Clear? It uses the ranked historical returns to estimate the VAR and its confidence interval. Clear? Second is bootstrap method. Write down. Creates multiple random samples. It creates multiple random samples. See, they are using the random samples, okay, from historical data, and calculate the VAR for each sample. Means you have taken 20 sample set and you have calculated the VAR. Again, you take the 20 samples, you calculate the VAR. Like this, you will have multiple VARs. Clear? Now the final, write down the final confidence interval. The final confidence interval is based on the range of these VAR values. So you will identify that what is the range, means highest it came 120, lowest it came 90. So you say that my VAR is within the given range of 90 to 120 with the help of the multiple VARs. You have calculated multiple VARs and all the time you have seen that VAR is coming within this limits. All the time you see VAR is coming within this limit. So you said that, see, this is my confidence interval. Clear? Now suppose we have 100 days of past return. Suppose we have, 100 not, let us take 1000 days of past return. Okay. Now in order statistics, what we do? What we will do, write down, we arrange these returns from smallest to largest, and take the worst 1% return to estimate VAR. to estimate VAR. Means using normal distribution like this. Okay, we have plotted 1000 data set. Over here is the lowest return and over is the highest return. So if you have 1000 data set, then its 1% will be how much? 10. Now 10th point is over here, that is -7%. -7%. So we call this as a order statistics. Clear? Now bootstrap, we are picking up the random samples. Now very important, with replacement means we will put up those values again to the basket and then we will pick up 20 again. So write down with replacement, because if we will not do replacement, then our data set will start reducing. Clear? So like this we will calculate the VAR many times and then we will use the spread of these estimate to determine the confidence intervals. Clear? Now write down the historical findings. Give a hash historical findings. Now when I say historical findings, so studies have shown that confidence interval are not always symmetrical. Means the potential downside risk can be much larger than the upside risk. Means there is a chances that the market will crash more than the market will go up. Clear? So there is more downside risk, clear, than the upside. Clear? Now apart from this, we have observed one more thing. When you have more data, then you have a tighter confidence interval and it is more precise estimate. So when you have more data, your confidence interval is tighter and you are getting more precise estimates. Clear? When you are using a GARS model to calculate your VAR, that actually adjusts the changing volatility, that also produces a tighter confidence interval than simple historical VAR method. Clear? And during the stress period like financial crisis, confidence interval widens. Okay, means the risk estimate become less precise because extreme losses become more and more unpredictable. Means in that situation, during the stress period, you cannot identify the risk properly because of the fact that there are possibility of high losses and without any prediction. Means you cannot predict in this scenario, in the financial crisis scenario, what can happen. Clear? So many VAR models during the 2008 financial crisis, they have predicted the loss. Clear? But they are much smaller as compared to the actual market losses. Clear? So this is our point LOSC. Clear? Now one more LOS left in this topic, that is your benchmarking the VAR model. Give the heading benchmarking VAR model. See, after watching the lecture, all you need is to just give a thorough reading to the notes and then you are done with the topic. Clear? See, the purpose of benchmarking is comparison. Okay, you compare yourself with something else. So when I am saying benchmarking VAR, means there are two models. They both are evaluating the risk. So what you are doing? You are comparing them. Clear? Write down benchmarking VAR means comparing a bank's VAR model to another model to see if it gives accurate and reliable risk estimate. Means suppose both of you are using VAR model A, VAR model B. Clear? But now you want to switch from A to B. Clear? Now currently you are using A and this is VAR model B. Now you want to decide whether to shift or not. On what basis? Only if your model B is better. Clear? So what the bank will do, they run both the models side by side for a shorter period of time. Clear? Now you will see which model is giving more accurate and more stable risk estimate. Clear? If model B gives you more accurate and stable risk estimate, bank will switch to it, otherwise bank won't. So benchmarking is most specifically, it's all about comparing. It's all about comparing the risk. Clear? Now, do you think bank used to do it regularly on a regular interval? No. There is a possibility bank can prepare thousands of models and every day they just keep on testing. No, it's not possible. Okay, why? Write down why it is not possible. Building a single war model is already difficult. How can you prepare so many? Are you understanding? Building a single war model is already difficult. How can you prepare so many? Clear? Second, having two different model to compare is very rare. Means they are designed for different purpose, different assumptions, different variables. So very difficult to compare them. Very difficult to compare them. And market changes so frequently that comparison will become very tricky. This is the third point, that market changes so frequently it becomes very tricky when you are comparing two different models. Clear? Now, when you are doing the benchmarking of the model, you will face challenges. Okay, and there are three major challenges which you are going to face. Clear? Now, what are those three challenges which we personally feel that benchmarking model can face? Number one, trading portfolios change too frequently. Trading portfolio change frequently. Trading portfolio change very frequently. Clear? So a bank portfolio changes every day due to the fact that they are buying and selling the asset. So this means that the VAR model error are not stable over time. Error is also changing. Clear? And if error changes frequently, statistical test used for comparison will become unreliable. Clear? I'll give you one example. Imagine you are comparing the performance of two cricket players. Okay, but one plays on a changing pitch in every match. Clear? Means player A and player B. Clear? So one plays on a changing pitch every match. Clear? Now their score may reflect the true performance because conditions keep changing, just like the war model. But if you'll compare like this, A pitch is changing daily, but B is playing on the same pitch. Do you think comparison is possible? In this situation, comparison is not possible. Are you understanding? So you can compare only when both are on the same position. Clear? Now many banks don't have two war models. Why? War models are expensive and very complex to build. So they just rely on the one model without a second model. So formal benchmarking becomes difficult because they do not have two benchmarking model. Clear? Third is simple visual comparisons are not enough. Means if you will plot the two war models from graph and then check which one is gives you the higher or lower risk estimate, it won't work well. Okay, because you have to dig inside the models. Okay, which one is more conservative for the bank's perspective? Clear? So formal benchmarking actually requires the statistical testings, but that also have lots of limitations which we have discussed before already. Okay, so benchmarking is very difficult. That's the conclusion. Okay. Okay, so I have discussed the challenges with you. Okay, three different challenges: that portfolio is changing frequently, they do not have two war models because it's costly, and simple visual comparisons are not enough. Now, how you will overcome? Means problem is there, I can understand, but what's the solution? Okay, since bank don't usually have two war models, clear, but they can use alternative benchmarking approach. Okay, write down the first one, backtesting positional war versus Garch war. Okay. Now, when I say positional war, write down what is this positional war is. This is the war calculated from the bank's actual portfolio position. War from actual portfolio position. Clear? And now you will compare it with the Garch war of P&L. Garch war of profit and loss. Clear? So this basically uses the profit and loss data. This model will use the profit and loss data to estimate the risk dynamically based on the changing market volatility. Because if there is a volatility, then the assets value are changing and profit and loss will be reflected in the PL, and that will give you the war which is considering the impact of the volatility. Clear? So by comparing these two, banks can actually check if their war estimates align with the actual losses or not. Clear? Suppose that bank's positional war says that war is $5 million. Okay, war is $5 million. Clear? But the Garch war based on actual PL suggests that the war is $3 million. Suggests that the war is $3 million. This means this is more conservative. You need to keep higher capital buffer, hence the lower profitability for the bank. Clear? Now this Garch war is actually closer to the actual risk level. Clear? But may not be suitable for the regulatory capital calculation. So for the purpose of regulatory capitals, you have to follow the original method, but for the purpose of comparison, you can use it. Clear? So if you'll ask me, positional war is more conservative because it is linked to the regulatory capital requirements, and hence it needs to be conservative. You need to have higher amount of capital. Clear? If you'll ask me accuracy, this will give you the more accurate answers because it adjusts for the market volatility. Clear? But at the end, we have to follow the method which have been prescribed by the regulators. Clear? For unexpected loss, positional war remains the preferred choice. Clear? So we have completed the whole topic. Okay. So all you need is to read the notes once, and I think your chapter is done. It was quite easy, theoretical in nature, and I have explained each and every term in detail. Okay, thank you.